Welcome to my channel. I'm Scott, and in this video we're going to talk about the S&P 500. And the S&P 500 is an index of 500 companies, and it's weighted by market cap. So Apple holds the largest weight. There are 505 tickers because some companies have two classes of shares. For example, Google, GOOG, GOOGL. There is a really slight difference between these two tickers. GOOG does not get voting rights, so the market cap is slightly lower. GOOGL receives voting rights. During this video, I am going to try to give you as much history and detail about the S&P 500. This happens to be one of my biggest investments. Almost half my portfolio is in the ticker SPY. The S&P 500 is widely considered one of the best gauges of the entire US market. You cannot directly invest in the S&P 500 because it is an index, but you can invest in one of the many funds that track its performance. The following ETFs can be purchased in order to track this index: SPY, VOO, SPLG, and IVV. The tickers VOO, SPLG, and IVV offer the lowest expense ratio. All three of these ETFs have an expense ratio of 0.03% or 3 basis points. Ticker SPY is the most liquid of the four ETFs, meaning it has the highest trading volume. If you wanted to trade options on the S&P 500, then ticker SPY would be your best choice. BlackRock manages ticker IVV. Vanguard manages ticker VOO. State Street manages tickers SPLG and SPY. Ticker SPY is the first ETF to be listed way back in 1993. It is also the largest ETF in terms of market cap at close to $500 billion. ETF stands for Exchange Traded Fund. It is a basket of securities that trade on an exchange just like a stock does. ETFs can contain all types of investments, including stocks, commodities, or bonds. Some offer US only holdings, while others are international. Anytime in this video, if I say the index, I'm referring to the S&P 500. The index includes 500 of the largest companies whose stocks trade on the New York Stock Exchange or NASDAQ. The index is not the 500 largest companies, but they are 500 large companies. The 500 companies in the index make up 80% of the value of all US publicly traded companies. The index is very diversified. It invests in 11 sectors, with no more than 30% in one sector. The largest sector is information technology, then healthcare, consumer discretionary, financials, communication services, industrials, consumer staples, real estate, energy, materials, and utilities. The companies that go into the index are selected by a committee. The S&P 500 committee operates within specific guidelines. In order to be eligible for the index, a company should be a US-based company, have a market cap of at least $13.1 billion, be highly liquid, and have a public float of at least 10% of its shares. This means insiders of the company cannot own more than 90% of the shares. The company must be profitable in its most recent quarterly earnings. These are some examples of rules to be added to the index, but after you're added, you could have negative net income. It is common a stock price goes up when it is added to the index, since index funds like ticker SPY must purchase that stock to continue tracking the index. On the flip side, a stock may decline in value when it is removed from the index. Most professional investors do not beat the index, yet those professionals charge fees of 1% to 3%, while the ETFs we mentioned earlier charge fees as low as 0.03%. That means there are many people watching this video now that are paying their financial advisor fees 100x more and getting worse results. The 9 largest companies in the index account for 28% of the market cap. These are the top 9 companies from largest to smallest: Apple, Microsoft, Alphabet, Amazon, Meta Platforms, Tesla, Nvidia, Berkshire Hathaway, and JP Morgan. That is why this index is called a market cap weighted index, as opposed to the Dow Jones Industrial Average, which is a price weighted index. To give you an example, say there were two companies in the Dow Jones. One company had $1 trillion market cap and was trading at $50 a share. Another company had a $100 billion market cap and was trading at $100 a share. The company with a $100 billion market cap would have twice the weight as a $1 trillion market cap company, because the $100 billion market cap company has a stock price double the $1 trillion market cap company. $100 is double 50. The market cap of all 500 companies combined is over $42 trillion. There were several years where the index declined over 30%. The index has posted annual increases 70% of the time. However, the index has made new highs only 5% of trading days, which means that on 95% of trading days, the index has closed below its all-time high. The index opened on January 2nd, 1957 at $46.20. 38 of those 500 original companies are still active in the index, such as Ford, IBM, and Coca-Cola. On Black Monday in October 1987, the index realized its worst daily percentage loss, falling 20.47% in a single day. On February 2nd, 1998, the index closed above 1,000 for the first time. On November 20th, 2008, the index closed at 752.44, its lowest since early 1997. Imagine investing in 1997 and 11 years later, your investment is flat. On August 26, 2014, the index closed above 2,000 for the first time. If you invested in the index for 20 years, regardless of what day you invested on, there's a 100% chance your investment went up. I hope this video helped you learn more about the S&P 500. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.